CNBC TV 18, celebrating 15 years of leadership.
Hello and welcome to Markets Today. I'm Lata Venkatesh, and joining me from the New Delhi News Centre is Surabhi Upadhyay. Well, it was a day that saw significant gains for the Sensex and the Nifty and even the mid-caps. It appears that this is largely because traders were pushing back positions which they had to unwind at the year end. Now there is a little more breathing space, so they're taking on positions. We will know the real merit of the global cues only tomorrow, because many global markets were closed today for Easter holiday. Hi, Surabhi.
Hi, Lata. Yes, well, a good day to start, a good way to start the week off nevertheless. Lots to talk about over the next half an hour. Let's start with the headlines. The Sensex and the Nifty rise almost 1%, led by pharma and FMCG and capital goods stocks as traders take on positions ahead of the year-end. Many Asian and European markets remaining closed for Easter helped domestic traders dominate.
Mid-cap index rises 1% in step with the frontliners. New listed Ad Labs Entertainment manages to recover from morning lows to end 7% higher. Realty stocks like HDIL, DLF and Unitech rally between 5 and 25%, probably because of the land bill. Sun TV falls 9% after the Enforcement Directorate attaches assets worth 742 crores belonging to the Maran brothers.
Auto sales in March are weak. TVS Motor sees flat domestic sales, while Bajaj Auto posts an 18% decline in total sales. Rajiv Bajaj says markets like Egypt are a challenge, but he remains confident of Bajaj Auto getting back to 20% market share in the domestic market in the first quarter.
The Reserve Bank is unlikely to cut repo rates at the credit policy tomorrow, though there is a small chance it will cut banks' SLR holdings, says the CNBC TV 18 poll. The rupee gains on dollar inflows while bonds hold steady ahead of the credit policy. Well, those are some of the headlines that the markets gave us. And here are the top voices that we are getting for you on the show. Sanjeev Prasad of Kotak Institutional Equities, Mark Matthews of Julius Baer Bank, and Bhanu Babeja of UBS.
All right, so lots of opinion coming your way, but first the action on the street. Anuj Singhal now joins in with all the details of the day's trade. Anuj, it seemed to have been a good start to the week for the markets.
Indeed, the weekend was long and the bulls were totally charged after the kind of weekend they would have had. But I tell you something, the market had a real big surge in the second half. The first half was quite muted. The market at times was looking like it was tiring out, but the second half really belonged to the bulls. And there were a lot of stocks that did well in the second half. But again, pharma led the way yet again, and you had a lot of these real estate names doing their bit. So all these names looked quite good. Let's talk about the pharma stocks first. Sun Pharma, Dr. Reddy's, Cipla, all of them were higher in trade. So that clearly was the sector of the day. Apart from that, some other stocks that led the market higher included oil and gas stocks, KN India, ONGC, GAIL. This looked like more of short covering bounce because all these stocks had been beaten down quite a bit. So some sort of rally was there in some of these names. Apart from that, the other pocket where we saw some gains included some of the heavyweight stocks like HUL. That was back above 900. ITC was up 2.5%. And NTPC was up about 2.5% as well. On the losing side, there were a few stocks across various sectors. PNB was down 2%, Reliance was down 1%, and IT continues to look weak. That sector was down, and Wipro was down about 2%. But high beta really had a field day in the second half, especially in the last hour of trade. Take a look at some of these names. HDIL was up 24%. Keep in mind, no circuit, it's an FNO stock. Unitech was up 8%, India Bulls Real Estate was up 7%, and some other prominent names in the mid-cap basket that rallied today included Educom, that was up 10%, Aban Offshore was up 8%, and that's the listing of the day. Ad Labs Entertainment, it opened at a discount to its issue price, but finally managed to close with 7% gain. Tomorrow is the big RBI policy. Now, the market right now is not pricing in any kind of rate cut, but it will be interesting to see what happens to the market, because last time there was a rate cut, the market had actually topped out. So it will be really interesting day tomorrow on the RBI monetary policy day.
All right, Anuj, thanks. We'll come back to Anuj for all the futures and options action in just a bit. But first, let's hear out what Sanjeev Prasad of Kotak Institutional Equities has to say about the markets, the upcoming earnings season.
What I'm getting increasingly worried about is the fact that valuations are getting quite stiff now, especially if you look at the high growth, high quality names. The valuations have become really expensive over there. You have a lot of sectors which don't look very good at this point in time. In the energy space, there are lots of challenges still. The government still not has devised a proper supply sharing formula. The metal and mining space, is very difficult to invest in. And then you have the high quality names in consumers, pharma, etc., which have become very expensive. So that doesn't leave you with too many, sectors and stocks as of now. Preliminary numbers we have put out for autos as also the banking sector. We already seen some downgrades in both the sectors. Technology also we have seen downgrades. So I won't be too surprised by the end of this quarter when I say the March quarter. Results will be out by May 30th. As of now, for the full year for fiscal 16, we are looking at about 16% growth. I won't be surprised to see at least a 1 percentage point or maybe even 2 percentage points slash in earning numbers by the time we end the result season. So we could be down to about 14-15% growth for the PSA30 index for the March 2016 year.
Right. The Reserve Bank will be announcing its busy season credit policy, the first policy for the new financial year. CNBC TV18, of course, did the customary poll, and here's what we found, some important findings. First up is the move on the repo. That's exactly what the entire market will be watching out for. Our poll found that 75% of those polled did not expect or do not expect a rate cut. So it will stand at 7.5. That's the expectation. 25 is some people, of course, a quarter of the people polled expecting a rate cut. On CRR, it was an even more emphatic no. People not expecting a CRR cut at all. Just about 15% expecting a minor CRR cut. I'll also go through the SLR cut and then come back to what reasons people told me. On SLR, this is the total percentage of their deposits that banks must keep in the form of government securities. On SLR, the poll said that 60% are not expecting a cut, but 40% are expecting a cut. So this appears most likely. It is likely to be a non-action policy, but if at all they do anything, it will be on SLR. These are very important. What they expect to hear from the governor on GDP. Will he forecast a very good growth? No. 60% say it will be 7.5 to 7.9. Remember, even for the current, for the year just gone by, the CSO is going with a 7.5%. So 7.5 to 7.9 really means that the governor will not be very gung-ho on growth for the current year as well. And then, of course, what the governor says on inflation will be very closely watched. Will he say anything about the ability to reach that 4% inflation in January 2018 will be closely watched. People whom we spoke to, a majority of them, don't give the government give the Reserve Bank a very big chance of achieving that. About 35 or 40% give the RBI a very poor chance of achieving that 4% CPI by 2018. Well, not CRR. Actually, I want to just pull up the repo plate once again. The repo would be the thing that people would most watch out for. There, the market is actually now getting a little more evenly divided. Some people believing that the Reserve Bank may not push it till June if he thinks growth is really weak, because by June there could be fears of the monsoon not being too good, food inflation rising, as well as some fears that the Fed might hike, although the non-farm payroll numbers came in not so good. So there is still a fear that, or still a hope, an expectation that the governor might give that one more rate cut tomorrow rather than in June. But the market, the respondents whom we spoke to, still believing that the rate cut will come later and not tomorrow. Over to you, Surabhi.
All right, Lata, thanks for that analysis. Obviously, if the rate cut does come through by some chance tomorrow, it perhaps is going to make market participants extremely happy. On that note, let's get you some more commentary, some more expectations. Here's the call at Nomura and JP Morgan with respect to tomorrow's policy.
Our base case is for no more cut. I think the language used in the March surprise intermeeting statement was that RBI has preempted the rate cut given weakness in the economy. So our sense is that RBI has front-loaded the interest rate cuts in order to give more time to banks to respond going forward. So I guess the focus in this policy should be much more on transmission rather than RBI actions per se. So unchanged at the April policy is our expectation.
The focus is very much to keep real policy rates positive. The governor has actually given us a range of 1.5% to 2%. We have to look at that across the cycle. So it's unlikely to be the case that inflation remains at 5% over the course of the economic cycle. Our own forecast is somewhere between 5.5% to 6%. So if that is where inflation averages over the next 12 to 18 months, and you add on 1.5% to 2% in terms of a real rate, you're looking at the policy rate somewhere between 7 and 7.50. So I think 7.25 is where we are.
All right, from all that credit policy talk, let's come back to markets and get you some international opinion. Mark Matthews of Bank Julius Baer believes that Indian markets are unlikely to see a huge gain in the near term. He in fact believes that Chinese equities are currently priced much cheaper than their Indian peers.
I'm not looking at a huge price gain between now and even the end of the year, I'd have to say. In the longer term, I still think it's a superb market for all the reasons that we've talked about in the past: the high return on equity, the very large and young population, the new government, the infrastructure that's going to be built. It'll all happen, but not probably as fast as people had anticipated. I've been very bullish on India, and I must confess that my bullishness has been tempered by the weak earnings season. You just can't deny that the earnings were poor, particularly in the banks. I think in the context of China, which is much cheaper and clearly on a tear, that India probably doesn't do a whole lot for the next few months.
All right, moving on. We do not support tax terrorism, but India is not a tax haven either. That's the message from Finance Minister Arun Jaitley. That's the message he had for corporates and for FIIs around the world. Speaking at a CII event, the Finance Minister hit out at the recent controversy surrounding new tax demands raised by the IT department. He said that India is not so vulnerable that even legitimate tax demands need to be waved off in order to soothe the nerves of foreign investors and attract investments. Strong words there, and giving the Finance Minister company was the Revenue Secretary Shaktikanta Das, who said that MAT dues, minimum alternative tax dues, are payable by FPIs for the year just gone by, that is FY15. He was speaking to CNBC TV 18, and he said that FIIs and FPIs, that is foreign portfolio investors, are in fact now seeking retro exemptions. Let's hear both the Finance Minister and the Revenue Secretary.
An emerging economy which expects investment cannot really indulge in what was being referred to tax terrorism or a very aggressive tax policy. But our fairness has been partly misunderstood. The converse of tax terrorism is not a tax haven. And if I read the front page of some newspapers, that's the impression that I get. Taxes which are not payable must not be paid. They should be challenged. But taxes which are payable must be paid.
I think what the FIIs and FPIs are asking is retrospective exemption, not retrospective application of a tax law. Now, because MAT was leviable on them, that is why these assessments, these demands have been raised. Some FPIs, some FIIs had gone to the Authority for Advanced Ruling. The Authority for Advanced Ruling gave a decision saying that MAT is applicable, MAT is leviable. Naturally, the income tax officers, the assessing officers have raised their demand. Simultaneously, they had represented their difficulty to the government.
All right, time for a break now, but coming up, we will be shifting gears to Motown. And as far as March auto sales are concerned, the sector is still not out of the woods. All the details when we come back.
CNBC TV 18, celebrating 15 years of leadership.